I know you both work at banks, so you both have a certain perspective professionally, I suppose. But what is it better to go to a non-bank source even if you're paying more? Are there different requirements? Is there more freedom? Are there different opportunities out there that people should be tapping that they haven't been tapping enough, do you think?
Well, what's interesting, if we actually just looked at this a little while ago and looked at middle market companies, and this is more from a leveraged finance perspective, and where people are getting their financing relative to where they were getting it, say, 6-7 years ago. And there's actually been, between banks and, so in 2009, kind of at the height of the financial crisis, you looked at middle market companies, about 30% of that financing came from banks, and 30% came from finance companies, and the rest was, institutional funds. If you look at that same number now, banks are probably providing less than 10% of that capital. Finance companies, there's fewer and fewer finance companies out there. There's more, as Mark was saying, BDCs or institutional funds. So I think where people are getting it right now, it's shifted. That isn't to say the banks shouldn't be in the mix. The word of advice that I would give, I think it's if you know where to tap the sources, there's a lot of capital. But I don't think you want to take the banks out of the mix completely. And I think there are a lot of lessons learned in the financial crisis, and companies ran into trouble, and they didn't really know who their financial partner was. I think banks in general, it's going to be a cheaper source of financing. It might be a little bit more stringent or structured, but it's going to be a lot more predictable. So I think the advice that I would give a lot of middle market companies, make sure you know who you're partnering up with. And that isn't to say, hey, it's exclusively I'm going to do a deal with a bank and I'm going to do a deal with a BDC. I mean, there are structures out there where the bank could take the first part of the capital strip and maybe another institution takes the second part. And it's kind of how those institutions work together.
There's a lot to unpack that I want to get to, but Mark, let me just ask, do you think this is a permanent new reality for banks? I mean, we're still in some ways, it's been slow, we're still in some ways recovering even from the downturn. The regulatory climate, of course, has gotten stiffer, I think in some ways, which you can speak to, that may restrict some of what you can do. Maybe people are thinking this is a period that will pass and banks will be right back to where they were. Is that ever going to happen, or do you think
I think we're finding a little bit of a middle ground. I think the capital markets continue to evolve with the different sources of capital out there. Right now, it's plentiful because there's a very low rate environment and everybody continues to chase yield, and it's just hard to find it anywhere. So we've seen the middle market become a more attractive asset class. But I think that there's a common ground that is currently shaping up between where banks will play and the importance of banks in a company's capital structure, and also where some of the other providers will play. Because remember that the banks it is the cheapest source of capital, but also provide some very important operational services to companies as well. And that's always a core part of that relationship. And as Jim said, that number one issue is to maintain a consistent relationship with an entity that will be there for you when you need them, if you need to grow your business, but also in a potential downturn where you need to rely upon them.